Welcome to TalkTickers.
Hello, everyone.
Today, we are pushing past our usual company-specific earnings summaries to do a deep dive into an indicator that really dictates the entire macroeconomic environment that all companies have to operate in.
We're talking about the yield curve.
Exactly. The yield curve. That's right. And for anyone trying to stay ahead of, well, the curve, and yes, we'll take the term spread, which is just the slope of that yield curve, has a historical record for forecasting economic shifts, that is.
Right.
It's almost unnerving.
It really is. It commands a lot of respect, even from skeptics.
For sure.
So our mission today is pretty straightforward. First, we're going to dissect why this deceptively simple measure has such terrifying predictive power. Then we'll get into that perennial question, is this time different?
Yes. The four most dangerous words in investing.
Right. Especially with, today's low rate environments. And finally, we'll look at what happens when you throw advanced techniques like machine learning at this old school benchmark to see if they can, find a better way to predict recessions. It really is a classic battle, isn't it? Simplicity versus complexity, all to find the core truth of the market's expectation.
Okay, let's unpack this with the basics. Defining the key term is everything here. So when we talk about the term spread, what are we actually defining?
We're simply defining it as the difference between long-term interest rates, think the 10-year Treasury yield, and a short-term rate. Usually it's the 3-month yield.
And the really critical moment, the thing everyone watches for, is the inversion.
Right, the inversion. That's when the term spread turns negative. So it means you're actually earning less interest by holding a 10-year bond than you would by holding a Treasury bill for just 3 months.
Which feels completely wrong intuitively. I mean, for a functioning market, you expect to be compensated for taking on risk over a decade, right?
Of course.
So when that relationship flips, it suggests a profound loss of confidence in the short to medium term future.
Absolutely. The market is effectively betting that future short-term rates are going to be dramatically lower than current short-term rates.
And that typically only happens in a severe economic slowdown.
Exactly. And the historical accuracy of the signal is just stunning.
How stunning are we talking? Give us the historical box score.
Okay, so since the mid-1950s, if you use a very simple rule of thumb, predict a recession within 2 years of the spread turning negative, you would have correctly signaled all 9 U.S. recessions.
Every single one.
Every single one was preceded by a yield curve inversion.
100% success rate on calling recessions. That's incredible. But did it ever give a false alarm? It inverts, but a recession never actually shows up.
There was only one notable false positive back in the mid-1960s. The inversion was followed by a pretty significant economic slowdown. Some people call it a growth recession, but it wasn't officially designated as a recession.
So out of 10 signals, 9 were perfect and 1 was a near miss.
Which is why it's considered the most reliable indicator we have.
Okay, so if the curve inverts today, should we panic tomorrow? What's the timeline?
No, not immediately. The delay, that lag between the inversion and the official start of the recession, it typically ranges from 6 months up to about 2 years.
6 to 24 months.
Right. And that window is absolutely crucial for policymakers and for investors. It gives you time to prepare for what's likely coming.
Now let's dig into the mechanics. How does an inversion actually happen? When we see the curve flatten and then flip, what's driving that? Is it the long rates dropping or the short rates surging?
It's usually the short end of the curve that does all the heavy lifting, and it's almost always tied to the central bank.
The Fed.
The Fed. The decline in the spread is generally driven by a really pronounced increase in short-term interest rates. This happens because the Federal Reserve is actively tightening monetary policy. They're raising rates to cool down inflation or an overheating economy.
So the Fed is hiking aggressively, driving up the short-term cost of borrowing.
Precisely. And meanwhile, the long-term rates, which are supposed to reflect expectations for growth and inflation over a decade, they start to price in the consequences of that Fed tightening. They often increase much more slowly, or sometimes they even start to decline.
Because investors get pessimistic.
Exactly. They see the Fed tightening and decide a downturn is inevitable. So they lock up their money in long-term bonds, which bids up the bond price, and of course that lowers the yield. It's a real tug-of-war.
The Fed's current policy versus the market's pessimistic future.
You've got it.
So if the historical record is that strong, there must be some solid economic theory behind it. And to understand the why, I think we have to go back over a century, right? To Irving Fisher's principle from 1907.
We do. Fisher basically suggested that interest rates, in a state of equilibrium, reflect the marginal value of income today versus the marginal value of income next year.
In simpler terms, if I'm sure that times will be flush next year, I'm willing to borrow now to invest, because paying it back will be easy.
Correct. But if you think times are going to be tough, a recession is coming, maybe you'll lose your job, you have a really strong incentive to save money now.
Right, so I can spend it later when cash is scarce.
Precisely. And that incentive to save drives up demand for long-term bonds. Investors, they're expecting trouble, so they want a safe haven, a guaranteed income years from now. This surge in demand bids up the bond prices.
Which lowers their yield.
Yeah.
The market is literally pricing weakness into those long bond yields.
That's the mechanism.
This sounds like it directly connects expected consumption growth to interest rates, which brings us to some heavier academic concepts. The consumption-based asset pricing framework.
It does, yeah. It links expected real consumption growth to expected real interest rates. And the key variable here is how sensitive our consumption is to those expected rate changes.
They call that the elasticity of intertemporal substitution, right?
A mouthful, I know. But it's just about how much you change your saving or spending habits based on future expectations. If the market really believes a recession is coming, that elasticity gets very high, investors drastically change their behavior, and the yield curve becomes a very, very strong signal.
Okay, that gets abstract pretty quickly, which brings up a critical question. If the core economic theory is all about real interest rates, so rates adjusted for inflation, why do all the studies insist on using the nominal yield spread as the best predictor?
That is a great question. Shouldn't the theoretically purer real rate signal be better?
Exactly.
Well, this is where the data really proves its worth. Empirical findings show pretty consistently that using the nominal yield spread variable is superior to using real rates alone. And the reason is technical, but it's vital for prediction. It's about managing volatility.
Help us simplify that. What do you mean by volatility?
Think of it as noise in the data. The joint process of, say, consumption and interest rates is just full of noise, or what we call non-constant variances. When you look at the real interest rate by itself, that noise can really obscure the underlying signal.
But by looking at the difference between long and short rates, the spread,
Yeah.
you're filtering some of that out.
You are. You essentially minimize the impact of much of that shared volatility. Since both the 10-year and the 3-month are subject to the same general market noise and inflation volatility, taking the difference cancels a lot of it out.
So it leaves a much cleaner signal of the relative expectation. The spread is just more robust.
Exactly. It measures the relative change in market expectations, and that makes it the most reliable tool in a volatile world.
So with a track record this perfect, why does anyone ever argue this time is different? Every time the curve flattens, the commentary just floods with these don't worry about it arguments.
It's an inevitable debate, especially when economic conditions are, unusual. The most common argument lately has been that because overall global interest rates and risk premiums have been exceptionally low.
Since the great financial crisis, basically.
Right. The argument is that the traditional relationship may have changed. The idea is that an inversion might now just signal lower future rates because we're successfully controlling inflation, not that we're predicting a dramatic slowdown in growth.
The actual definition of a recession.
The actual definition. So maybe the curve just reflects the Fed being excellent at guiding the economy to a soft landing.
It's a compelling hypothesis.
Yeah.
So how did researchers test it?
Well, they ran extensive statistical analyses. They incorporated all these factors, like the overall low level of interest rates. They also looked at something called R-star.
The natural policy rate. Can you define that for us quickly?
Sure. R-star is the theoretical interest rate that balances savings and investment when the economy is at full health, full employment, stable inflation. It's a really crucial concept for modern monetary policy.
Okay, so researchers plugged in R-star, the low level of rates, all these complex factors, hoping to build a better, more nuanced model. What was the verdict?
The verdict was pretty shocking. Incorporating all that complex context R-star, rate levels, risk premiums, it did not statistically improve the predictive accuracy over the simple term spread.
Nothing.
The simple 10-year minus 3-month still reigns supreme.
So all that effort to optimize the model, it didn't add any value. It didn't make the forecast clearer or faster.
Correct. And they dug even deeper. They tried separating the spread into its two components. the expectations part, what markets think the Fed will do, and the term premium part, which is the risk premium.
Yeah.
Surprisingly, both components carried the same signal for future recessions. Separating them didn't improve the forecast. The complexity just offered no edge over the simplicity.
Okay, this is where it gets really interesting for me. When is the recession signal the loudest? Is it the exact moment the curve crosses zero and inverts?
It's a bit more counterintuitive than that. The moment of greatest danger, the highest probability of recession, often occurs not when the curve initially inverts, but after it's been inverted for a while, and then starts to uninvert.
Wait, why is the curve normalizing a bad sign? We should be happy the spread is widening again.
You'd think so, but that normalization often happens for two reasons. One, the Fed has started to dramatically cut short-term rates to fight the recession that's already starting. Or two, long-term rates are surging because the market realizes the recession is here and things are shifting fast. That move from inverted back to normal often signals the recession is either imminent or, frankly, already underway.
And what about these recent outlier situations where the curve has stayed inverted for a really long time, sometimes over 600 days, without a confirmed recession?
That is precisely what defines an unusual outlier situation. Historically, it's very rare. If the economy stays strong despite a prolonged inversion, it suggests the scenario where the Fed has managed to fight inflation without triggering an immediate downturn. But even then, the signal remains a massive red flag.
All right, let's talk about challenging this with the most advanced tools we have. If statisticians couldn't beat the 10-year, 3-month spread by adding economic variables, what happens when we unleash machine learning?
The optimization question was really the key. I mean, the traditional benchmark uses the 10-year minus the 3-month, and it just assumes both rates have the same absolute effect, just in opposite directions.
But that's just an assumption.
It is. So researchers wanted to use machine learning to search for the mathematically optimal maturity pair and to relax that constraint on the coefficients.
What specific tool did they use for that?
They used something called L1 regularization, or lasso. You can think of lasso as an intelligent variable selector. It penalizes complexity, so it forces the model to select only the most useful, simplest set of variables and coefficients.
So the goal was to see if Lasso could find a better combination, maybe the 15-year minus the 6-month or something like that, and assign them different weights.
Exactly. And the algorithm did find alternatives. ML frequently selected pairs other than the conventional 10-year 3-month. For shorter forecasts, it might pick the 10-year 6-month. For longer horizons, maybe the 20-year 1-year was sometimes optimal.
And what about the influence of the two yields? Did it confirm the simple one-to-one assumption?
No, it actually challenged that assumption. The machine learning analysis suggested that the coefficient on the short-term yield was often larger in magnitude than the long-term yield's coefficient.
So the rate the Fed controls, the short end, it plays a slightly bigger role in the prediction than the simple model assumes. That's a real nuance.
It is. So ML found alternative pairs and alternative weights that were mathematically better inside the testing data. It really looks like a clear victory for the advanced models.
So if the model is mathematically superior, why isn't the simple spread obsolete? This is the core tension of the whole deep dive.
And that brings us to the most surprising and I think definitive conclusion of this research. Despite identifying these optimal pairs and ratios, the improvement in out-of-sample prediction performance.
Meaning how well it did on new real-world data it hadn't seen before.
Exactly. That improvement was not statistically significant compared to the simple, decades-old 10-year 3-month spread.
Wait, why not? If it's mathematically better, why does it fall flat in the real world?
It all comes down to a concept called estimation risk. The statistical uncertainty, the noise associated with optimizing all those coefficients and selecting the perfect pair was just too high. The risk of overfitting the historical data was greater than the slight mathematical gain the complex model provided.
So in the end, the simple measure is the most reliable because the cost of trying to squeeze out that extra bit of accuracy just isn't worth the risk of being wrong. The noise reduction of the simple spread is its genius.
That's the powerful synthesis, yes.
We've gone from a 1907 principle through modern statistical challenges, all the way to advanced machine learning, and the consensus holds. A negative term spread is a serious concern for the economic outlook.
And the advanced techniques have, ironically, only confirmed the robustness of that simple established relationship. It suggests that even with all our computing power, sometimes the simplest measure, the one that reflects the market's collective judgment on the future value of money, is already capturing the most important shift perfectly.
Which leaves us with a final provocative thought for you to consider. What does it say about financial markets that the most profound economic signals often resist complex optimization? Why is that decades-old simple measure of the 10-year minus 3-month yield so difficult to beat? Is financial reality inherently simpler than the complexity we try to layer onto it? Something to chew on as you watch the Treasury market over the next few months.